Hi, welcome back to another podcast with Mr. Hagan. On this podcast, we're going to continue to talk about the expenditure approach to calculating the gross domestic product, where we add together all spending that goes in different categories. They are consumption, investment, government spending, and net exports. We add all those expenditures together, and that gives us the gross domestic product. It gives us all the spending in society, and therefore gives us all the production in society, which is what we are trying to measure. So in the last podcast, or previous podcast, I talked about if I bought a computer for my house, and we used the computer. My family used the computer to play games and just for personal use. That goes under consumption. That's spending by a household. It would be a good under consumption, part of gross domestic product. Now, what if I buy that computer, but instead of buying that computer and using it for consumption purposes, what if I buy that computer and I use it to help me manage my business? So maybe I purchase a computer. Maybe I buy a new truck to use for my business, or some new equipment. Maybe I buy a new oven if I'm running a restaurant. All of those kinds of things go under gross investment because they are capital. So if I buy a computer for my personal use, that goes here under consumption. But if I buy a computer to help run my business, now that computer is capital equipment. That computer is a tool used to run my business. This would also be true if I bought a vehicle for my business, if I bought a new oven for my restaurant, whatever the case might be. Any purchase of capital equipment, tools used for production, that goes under gross investment, and therefore becomes part of the gross domestic product. Because after all, somebody had to produce this capital equipment, and when they did, that had to get counted as part of the gross domestic product. So purchase of capital equipment is the first item that goes under gross investment, the purchase of tools for production. The second item that goes under gross investment would be the production of new structures or buildings. So typically what I mean by this is residential or commercial construction. So that means if I buy a house that was produced this year, that gets counted as investment, gross domestic product. Notice, by the way, that houses do not get counted as consumption, and there are reasons for that I'm not going to get into right now. What's just important at the moment is we put housing over here as an investment. Okay, so it goes under gross domestic product, under investment. This would also be true if a dentist, let's say, opens a new dental office and he builds a new building for his dental office. Then that would be a new building, commercial construction, that would go under investment, that would be part of the gross domestic product. By the way, it's important to say that if I bought a house that was built in 1950, that would not get counted as gross domestic product for this year. Why? Because the house was built in 1950. That house would have been part of the 1950 gross domestic product. So if I buy a used house, that is simply an exchange of property. They give me a house, I give them money. There was no production that happened. Okay, the house only gets counted if it was built this year, in the year that for which we are calculating the gross domestic product. Now, if I do buy a house that was built in 1950. That doesn't get counted as part of the gross domestic product. But if I pay a real estate agent or a lawyer to help me with the transaction, then that would get counted as a service and go under consumption, and that would get counted as part of the gross domestic product for the current year. And then finally, the third item that goes under gross investment would be changes in inventories. And the reason why we do this is let's say that a company produces cars, and they produce, let's say in some given year they produce 300 cars. So they produce 300 cars in this given year, but they only sell 280 cars. Well, what about the other 20 cars? They need to get, like, when they sell the cars, those are going to get counted as either consumption or investment, depending upon whether it was a business or an individual who bought the car. But either way, these 280 cars got bought, and they're all going to get counted as part of the gross domestic product under the expenditure approach. But what about the extra 20 cars that were produced and didn't get bought? They need to get counted because they got produced. That's the goal of gross domestic product, is to calculate everything that got produced. So how do we count these 20 cars? Well, we count them as part of a change in inventory, So we would say what happened is the company has to report this change in inventory, that they have 20 more cars sitting on their lot than they did before, and that is a change in inventory. I should define this word very quickly. Inventory is just stuff that's sitting in the shelf, sitting in the storeroom, that has been produced but not yet sold. That's going to be your inventory. That inventory gets reported, and we can now count that as part of the gross domestic product. So let me say that again. 300 cars were produced. 280 of them were either bought by consumers or investors, so we pick those up. When they get sold, we count those as expenditures, and therefore they get captured as part of the gross domestic product. The extra 20 cars that are now sitting on the lot, that will increase the inventories by 20 cars. And the way we treat this is we treat it as if the company bought those 20 cars from themselves, and then that gets counted as a change in inventory, which gets counted as part of gross investment, which gets counted as part of GDP, gets counted as part of the gross domestic product. So now we have consumption and investment, those two items that get counted as part of the gross domestic product. And on a future podcast, we will look at our last two, and they are government and net exports. Thanks for joining me. This has been Mr. Hagan on another podcast, and we'll see you on the next podcast.